learning module 5, capital investments and capital allocation. Before we get into the first LOS, the first LOS is about what are the types of capital projects. As a company, you make some profit. This is, let's say we use net income for this. With the net income, what are the two things we can do generally with the profit that you make? What is the two things that a company can do with it? Pay dividends, that is payout, or retain it or invest in it, right? So two things we can do. So one is payout, and this payout can take the form of dividends, as Rohan said, but nowadays a lot of companies also do buyback, share buybacks. They can also do that. Payout means either one, right? And then they can retain it. Retain as in for their use. What are the two uses? I just talked about that. When you retain it, you can use it for working capital or fixed capital. Investment in fixed capital. So this is what we are going to be looking. So to begin with, there is a bit of a theory discussion about the various types of projects, capital projects. But we can divide this capital projects into very broadly for investing in existing operations and for growing the business. Capital projects, we can use this capital for investing in your existing ops or for growing the business, right? Now, when you think about existing operations, some of this is just maintenance and some of this could be for another one. I'm just going to start with the maintenance type of projects. This is a going concern. Maintain the business. Maintain the business is if I have a factory, if I don't invest any money in it for a long time, what will happen to the capacity? It will deteriorate over time. There's depreciation, there's wear and tear. So even to just maintain the current production level or current output level, we need to invest. So that is the first type of CapEx maintenance projects. This is to continue current operations. This is fairly intuitive. You don't have to memorize these various items. You just need to understand what is the difference. So this can be also maintenance CapEx. That means replacing of spare parts usually, or some machinery that is end of life. You replace it. You're not adding to the capacity. I have a transformer that is supposed to have a 10 years useful life and I'm replacing. That is maintenance CapEx. I'm not increasing the capacity. Then it will go into grow the business. Okay, now other things could be improvement of efficiency. We want to reduce the cost or the raw material inputs. Efficiency improvement will also go under maintenance business. So maintain business. So they might ask a question, which of this is not a maintain business type of investment? So they will give you efficiency improvement, continue current operations, maintenance CapEx. And another one might be something like expand R&D or expand scope. And that will not be in the maintain business. So these kind of questions is what you will get, least likely to be a maintain business, things of that nature. Okay, what else can be a maintained business? Risk management. Nowadays, this has become an area of investment. These are all investing in existing or maintained business. Another type of investment that is also in existing operations is your regulatory and compliance projects. So in 2000, when is the 17 or so, when GST was introduced, a lot of the Indian companies had to invest in updating their ERP and being GST compliant. This doesn't expand the business, doesn't grow the business. It's a regulatory need that you have to invest in, right? So this could be for regulations, statutory laws. It could also be for safety laws if you are a manufacturer, keeping yourself updated. Okay, so this is existing operations. Now, when it comes to, so this part, this one shouldn't technically increase your revenue or things like that. The efficiency improvement might reduce your cost, but pretty much this doesn't increase the scale or scope or the capacity of your operation. That is what maintain business and regulatory and compliance means. Now, going into the grow business side, we will classify this into whether we are investing in new lines of business or if it is an existing business. I can even grow my existing business, or I can enter into a new line of business. Okay. This is not directly given in the curriculum, but oftentimes we use what is called as the Ansoff matrix. I think it's probably in your level two, right? So you might have used it in your work, right? This one is a useful tool to think of when we are thinking about expansion, right? So this was put forward by this strategist, it's like a management strategy consultant. And what he's saying is, this is just a framework for you to think about. Okay, so let's have a four quadrant. So in this on the vertical axis, we will let's say have whether it's a new product or an old product. So we will have the old product on the top and the new product bottom. On the left hand side, I'm going to have existing market, the market in which you are currently operating. And on the right hand side, a new market. Okay, so this box on the top left quadrant, old product, existing market is existing business. This is what you're doing. This is your product. And this is the same. Let's say you're operating and distributing in India. This is the space you're doing. Now let's talk about a company. This company, Asia or Asia. So automobile company. What do they produce in the two-wheeler segment? They produce the most popular Royal Enfields, right? Extremely popular vehicle in the 250cc plus category, right? They have a very high market share, correct? So when we look at Asia's situation, they are here. So what can they do to invest? Should they invest in this box? This is their, the Royal Enfield product categories, right? Like all the way, like, whatever they have, all those bike models, and they are operating in India. So if they invest in more in this space, is this a good ROI or not? We have to see because they almost have 80% market share in that space. Okay. How much more can they expand even if they invest? So they can do it, but we have to look at that. What is the NPV of that investment? This is called as market penetration. That is, you're already there and you're trying to expand the market share there, right? So this is market penetration. So this is the safest one, right? There is less risky, but the return might not be high depending on the current situation, right? Another example is London Fog in UK. They have like a significant market share in the raincoat and outerwear. So in those kind of scenarios, you might have no option but to think about expanding to either a new product or a new market, right? You invest in new product. So this one, if you come down in this quadrant, to do this, you need what? You need to do R&D. You want to invest, put in a new product in the market, you need to spend money on R&D projects. R&D means research and development. Okay. So this is called as product expansion, or they can move to the right, which is say in the case of Asia, they can take their bike, sell it in Europe or other parts of Asia. This is geographic expansion. The risk is the lowest here in terms of risk aspect. We have to compare it with the return, but risk wise, that is the lowest. Now, which one is in your mind like less risky, geographic expansion or product expansion? Generally, you already know the product and it is easier to export it to another country or, sell it in another country. Usually that is the first thing people try to do. It's not like you can't do this, but generally, this tends to be a slightly lower risk and this one tends to be a medium risk. Okay. Now, in fact, like HR went to Japan, they opened up a few stores in Tokyo, right? So they are trying to do that. On the bottom quadrant, the right bottom one is kind of a new product, new market. Both. Will anyone do it? Usually no one will do it. They'll first do either a new product or go to a new market and then they will introduce it. This diagonal that doesn't make a lot of sense usually because this is high risk. Not usually see this kind of a strategy. So we said the grow business I can categorize into existing business, which is basically your top left quadrant. In that one, we can expand the business size. So Asia can expand on production capacity or distribution reach. So this is a business size, or they can expand the business scope, maybe newer variants, or they are doing something slightly different, scope of business. They can also continue to make their products better, R&D, or do acquisitions that are related to the existing business line, either horizontal acquisition or vertical acquisition. Horizontal means like acquiring similar companies. Vertical means the supply chain, maybe the spare parts, engine makers and things like that that they can acquire. Okay, so this one tends to be a low to moderate risk, the existing business. On the right-hand side, the new lines of business, we have investments in new product development, NPD, which is always a riskier bet. If they want to move to, say, EV vehicles, first of all, we don't know how the market will react to Royal Enfield EVs. Is that something people will like? We don't know, right? So it's always risky. So you will do R&D on this one also. And this one is higher risk, right? So when we are going to look at this evaluation of this project, we have to use a higher discount rate. We'll talk about what it means for the risk. We have to adjust for that risk of the project. The next yellow is also a bit of theory, capital allocation. What is the first step in the capital allocation? What do we think about? If I want to allocate some to projects, the first thing is we need funds. And like, let's assume we have funds or we can get funds. The first step is we have to generate ideas, right? So first step would be to like, where do we invest, right? Usually ideas are cheap, right? It's everyone will have an idea. The sales department will have 10 ideas. The production department will have 10 ideas. They will all ask for money. But anyway, but if there are some companies where maybe they don't have enough ideas, idea generation, we need that, right? So idea generation is done. So there will be a team called as corporate finance team or FP&A team. There will be a person, a vice president or someone who's basically his job is to review all this. So his team will come up with ideas, but usually anywhere, any of the senior leaders can come up with ideas, idea generation. Then after this, we have to do investment analysis. This is the part that we are going to be doing in this chapter, the second step. So we need to perform analysis of the ideas, the projects, along with the business owner. The maybe again a corporate finance team is going to perform, and you're going to look at the return from the project. And in our learning module 5 here in corporate issuers in level 1, we are primarily going to look at this analysis in terms of NPV, IRR, and the third metric is called as return on invested capital. So we will use these three metrics to perform investment analysis in this chapter. Once you have done this investment analysis, then what do we do? That will be, say, hundreds of projects. Maybe you have money, but you can't invest in all projects. We have to do what is called as prioritization planning. So it goes to EC, executive council, or an investment committee, and they will look at the project, the metrics, the cost benefit analysis, sometimes also not only the financial metrics, but the strategic aspects as well. They choose it, as Avikshit said, planning and prioritization. Perfect. So that's the third step. After we do this, we also have to monitor it and see there could be some options afterwards. After you invest, you can either expand and things like that. So we have to monitor and also see if the objectives were met. Did you actually get that NPV that you were thinking about? The post-investment review, there will be some KPIs, key performance indicators, whether those are met or not. And again, this will lead to further future ideas for additional expansion, right? So this 4 steps are our capital allocation process. So we finished the first 2 LOS. What are the capital projects and the capital allocation process? Moving on, the third one, we are going to start with this first metric that we will see to analyze the project, NPV or net present value, right? So we will talk about how to calculate, but more importantly, you have to understand what it is, what is NPV, when to use it. Okay. The calculate LOS, we need to be able to calculate this number, net present value. If I told you we have $100 at some point in the future, what is the value of that today, right? So that is called as present value. What is the $100? Today is called as present value. So in your foundations, also this formula is there, right? Your future value, this you would have also studied in your school or college, your compounding equation, FE is equal to present value multiplied by 1 plus R to the power T, right? I can rearrange this and then also calculate PV as FV divided by 1 plus R to the power T. This is called as discrete compounding. In certain areas, we use continuous compounding, like say derivatives. But for our corporate issuers, we are mostly going to be using this kind of a discounting, discrete discounting, future value divided by 1 plus R to the power T. Let's talk about this $100. How do we bring it to today? So let's say my discount rate is 12%. So then the value here is going to be 100 divided by, if it is one period, 100 divided by 1.12, right? You can use the TVM, obviously, which is going to be our friend throughout the CFA course. All three levels you use it. You're going to do this first as a formula that comes to 89.28. So that $100 is worth 89.29 or so in today's value. This is called as present value. But in a project, you will not get only one cash flow. The project will generate multiple cash flows. So we are bringing it all to the present and then summing it up. That's what net present value, in simple terms, that's what it means. Okay. So let me give you an example of a project with some cash flow. So I'm investing, say, 50 million in a project right now, and we will have a project timeline like this. Right now is time 0. I am investing 50 million there. Then after 1 year, let's say we are getting some positive cash flow, 10 mil. After the second period, I'm getting 15 million. Third period, I'm getting 23. And fourth period, I'm getting 40. What we have to do is we have to discount all these four cash flow and subtract 50 million, because 50 million, do I have to discount? No, because it's already today's value. I'm investing today. I don't have to discount this. But these four, the yellow ones I wrote, have to be discounted to today. Okay. So let's do this discounting. You can use the formula, or better, you can use the time value of money. Tell me the first one. The discount rate I want you to use is 8%. Please calculate. So 10 in today's value is how much? 9.25. So I prefer the time value of money keys. If you guys like the formula, that's fine. You can do this formula 10 but divided by 1.08, and that is 9.259. Store it in a memory slot. Then the second one is 15 divided by 1.08 squared, and that comes to 12.86. Store in another memory slot. So these are the discounted values. The third one, I want to use my TVM keys because that's usually the safer one to use compared to the formula. My N is 3, I by Y is going to be 8%, we said. Present value is what we are calculating. There's no payment. Future value is 23. Compute PV, it is 18.25. The last one, I'm keeping on storing it so that I can add it easily. The last one is a 40 mil. Future value, I want to change the N to 4, compute PV, and that's 29.40. So these are the values I get discounted to today for those four cash flows. Yes. All right. So my NPV is now what? I just need to add, right? So all these ones, so recall one, which is 9.25, plus the second value, plus the third value, plus the fourth value. Then we subtract 50, and my NPV is 19.77. So what we have done here is we have added all these four with the 50 million. Then we got this as 19.77. So that's how we calculate the NPV. Okay. Now this is discounting the cash flow to today and then adding it all up. Now a better way to do this is to use the NPV function that is directly there in your calculator. But we are not going to use, if it is NPV, we are not going to use it because it's going to take a lot of time. Like for me, it took me almost a minute to do this NPV. We don't need to spend so much time. Instead, we are going to go to NPV function. And to do this one, we first need to input the data in the cash flow sheet. So go to your CF cash flow, second clear worksheet. CF0 is the initial capital out. This amount that we invest upfront is called as capital outlay. So this CF0 is a negative number. So make sure you type it as a negative number. Minus 50 at time 0, enter, then down arrow. Then your C01 is 10 million, 10, enter, down arrow. Frequency is 1. That how many times we get that cash flow, that's not going to change. Enter, down arrow. C02 is 15, enter, down arrow. Frequency is 1 again, enter, down arrow. C03 is 23, enter, down arrow. And the frequency is 1 time. And the last one is 40 mil, enter, down arrow. Okay. So that's the first step to a data entry of all the cash flows, the 5 cash flows, including the capital outlay. So we have the capital outlay as the 0 cash flow. Once you're done, you come to NPV. The I is your discount rate. So we press 8, enter, down arrow, and compute. And you should get the same answer that we got. This is called as net present value. And you can write it as a formula like what we did, either using the TVM or this cash flow function that we used. My NPV, if you're creating a Python code for this one, you should obviously have to create a formula. And so here, what we are going to do is the cash flow for each of the time period divided by 1 plus R to the power T. And we're going to sum up all this. This is called as the discounted cash flow. And I'm going to sum up that discounted cash flow for T is equal to 1 to N. This is called as the present value of the future cash flows. From this, I'm going to subtract my investment minus the capital outlay that we did, right? This is our investment. Okay. So this is the formula. If you want to use it as a formula, this is what we did, in fact, with the first time. And we did that cash flow divided by 1.08 to the power 1, 2, 3, 4, 5. And then we added it up and then we subtracted the 50 to get that 19.77. In fact, we used the formula. And the same thing, you can get it with the cash flow function and NPV from your calculator. So the project I gave you like this, right? Where I have one negative initial investment, capital in outlay, negative cash flow. And then I have positive cash flow that is called as a conventional cash flow. So you have this capital outlay, which is a negative cash at T is equal to 0. So you have this negative. Then after this, you have a positive cash flow. So this is a conventional cash flow, but not all projects are like that. If you've worked in projects, the team often requires subsequent cash infusion. So you might start with one negative 100. Then let's say next year it is positive. Then there might be some additional investment required, right? So you have something like this. Then you have a 200. Then you have some negative value, minus 150, like that. This kind of negative cash flows happening more than once is called as a unconventional cash flow. When you have unconventional cash flows, sometimes the IRR, which you will see later, becomes a bit tricky to calculate because there could be multiple IRRs. We will see that. But right now, we just want to understand the difference between conventional cash flow and unconventional cash flows. All right, so now I want to give you a simple practice on the NPV part. Okay. So initial capital outlay is 80 million, and then the cash out, the inflows are 25, 20, and 40. What is your NPV if discount rate is 14%? R is equal to 14%. Okay, CF0 is how much? Before I do this one, make sure you clear the worksheet because last time I input 4 cash flows. This time I only have 3. If you don't clear it, the 4th cash flow will still be there in the cash flow sheet. So I will do second clear worksheet. So then you can see that it is all now cleared. CF0 is 80 negative. Okay, it's outflow, right? It's outlay. So negative, enter, down arrow. C01, 25, enter, down arrow. C02 is 20, enter, down arrow. And C03 is 40. Down arrow. Then once you have that, go to NPV, compute. My I is now different, 14, enter down arrow, compute, minus 15.681. Okay. Now, should we invest in this project or what? What do you think? So you guys intuitively know that we can't invest in this project, even though I didn't say what is the decision rule with NPV. So the decision rule is fairly simple. If NPV is greater than or equal to zero, we can invest provided we have the budget. Like there are no better projects. We'll talk about how to identify that. If NPV is less than zero, then don't invest. Negative means it destroys the wealth. So if NPV is greater than equal to zero, sometimes it might be equal to zero, but there could be some strategic reasons, etc. You might still invest. But if it is negative zero, that means usually that's not a go ahead on that. Okay, now let's maybe think about what is NPV. If you are the CFO, you go to your CEO and you come up with this NPV for this project, right? We did this one, the first project, and the NPV was 19.77. How do you explain it to your CEO? Is this a profit? Is this a return? Is this how do you say this? NPV. How does it help the company? So NPV, what are we using profit here? What are these numbers? 10, 15, 23, 40. Is this a accounting number? Is that an accounting? What are we using in NPV? What is the input? Cash flow is not an income statement number. It's not a profit number, correct? It's a cash flow number we are using, and we are discounting it to today. When you discount cash flow, that is the value of the firm that will go up, or we can think of this as a wealth of the firm. If Reliance, let's say, announces a project for a new refinery, petroleum refinery, and they just announced it and they said, this project, it's going to take $1 billion and these are the expected cash flows. You will, forecast it and then you discount it to today. What is that? That's the expected value increase of Reliance. That is the wealth increase. So if you come up with an NPV of say $500 million, the market capitalization of Reliance should go up by $500 million. The wealth of the company should go up by $500 million, assuming the execution happens as we forecasted. Okay? There's always that uncertainty there, but assuming that happens as forecasted, the NPV is a wealth measure. Increase, it talks about the net worth or wealth of a firm. Later on in your equity and other areas, we discount the future cash flows to today and we talk about that as the value of the firm, right? So that is what we are basically doing here. Okay. Now, but a lot of people don't like wealth measure because it's not easy to understand. Like they like to see the rate of return on their investment. They want to know. If you talk to a CEO, they'll be like, okay, what is my return? Tell me that. What is my rate of return from this investment I'm making? So for that, we have this metric called IRR, right? IRR is the internal rate of return. You can think of this like your CAGR, compounded annual growth rate, similar to that. Now, how do you calculate IRR? That's very, the idea is simple. What is I have this equation here, right, for NPV. In this equation, if I can plug in an R such that NPV is equal to zero, that discount rate is my IRR. The IRR is the discount rate which if I use to discount the cash flows, then NPV becomes zero. That will give me the internal rate of return on that project, because at that rate of return, if I discount it, my cash flows become zero. That means that is the rate of return I am earning. So this is called as IRR. So now, as you can see, that is not a formula. It is a trial and error method. So you have to input various values of R to see when it becomes closer to zero. Okay. Just plug and play until you get so in your Excel, there is obviously IRR function. But you can also use, like if you have a spreadsheet, you can also use GoalSeek to get that value for R. For us, thankfully, we have IRR directly built into our calculator. We don't have to do any of that. We don't have to do trial and error. We just have to press the button, IRR. Okay. So IRR and then compute, and you get the internal rate of return. For the project that we just saw, the 3 cash flow project, my IRR is 2.838. 2.838 for this project. So my return is how much? 2.838% annual compounded. Okay. Annually compounded, I'm getting in the 3 years 2.83% return. What is IRR? When I made my NPV to be 0 instead of minus 15.68, then I'm using a discount rate of 2.838 instead of 14%. When I discount the cash flows at 2.838, then my NPV becomes 0. So I can even try that. If you go to NPV and instead of 14, if I use this 2.838, I don't have all the decimals, I should be exact. And then if I compute it, it's going to be pretty much 0. All right. Now, why? So now if you look at this IRR, 2.838, what do you think? Should we invest in this project or not? With the IRR, I'm getting 3% return almost. Should we invest in this project? No. Yes. The decision rule is very simple. Is the IRR greater than the hurdle rate or not? Okay. The hurdle rate is usually the discount rate that we use. Okay. So if 2.88% is less than 14%, we can't use it. Okay. The hurdle rate, IRR, we'll say, is greater than or equal to R, then invest. R is, we like to call this as the hurdle rate. Oftentimes, people equate it to the discount rate, but it not necessarily always. It can be the discount rate, which is, what we're going to see this, I'm afraid to use this term, a weighted average cost of capital. We'll see this later, how to calculate that. So that's basically your hurdle rate for the company. But for every specific project, if the project is more risky, they might add a little bit more to adjust for the riskiness of the project. If the project is safer, they might reduce the discount rate. Okay, so whatever is the hurdle rate for that project, we need to earn more than that on an annual basis. That is your IRR. So if the IRR is greater than or equal to R, then invest. If IRR is less than or equal to R, then don't. Less than R, then don't invest. So that's the decision rule on your bet. So IRR is for multiple cash flows, right? When you think about a return, you invest something and then you get something, right? And that is your holding period return for that period. This is for uneven cash flows. This project doesn't have same cash flow. You are projecting it, forecasting it, and then you're trying to find what is the rate of return we get on an annualized basis for that uneven cash flow. Okay? That is your difference. It is not, that's what I'm saying. It's not, in fact, I like to think of this as your compounded annual growth rate for those cash flows, the internal rate of return. All right, I'm going to ask a IRR question. So this is from your CFA curriculum, example 7, blue box. This is the time and the cash flow. Time is 0, 1, 2, 3, 4, minus 50, 0, 3, 40, and 25. Okay, if the hurdle rate is 10%, should we invest in this project? If the hurdle rate is 10%, should we invest in this project? Calculate the IRR, compare it with the hurdle rate, and say whether we should invest or opt in. All right. So the answer, if you do this, IRR is going to be 9.73%, which is less than the hurdle rate of 10%. So don't invest. Okay, now it's a slightly trickier question. What is the IRR for this project? This is from one of the mock exams. So here, time is given as in years, 0, 1.5, sorry, 0, 1, 1.5, and 2. And then they are saying the cash flow is minus 30, 20, 15, and 30. Okay. What is your IRR? So you would input it like general. So this will be your cash flow 1, 2, 3, like that you will input it. IRR, we have to calculate as an annualized number. Okay, what is the annual return? When you use this one, the time frame you have to use is like this. Okay, it has to have one thing for the NPV and IRR function to work is that the time frame has to be equal distance. Okay, otherwise it won't work. So what I'm going to do this is convert it into like this 0, 0.5, 1, 1.5, and 2. And this 0 is fine. This is going to be your CF1, this is CF2, this is CF3, and CF4. Then you will calculate the IRR. That is a 6-month IRR. Okay. The return for 6 months. Then you will annualize it. Okay. Some of you know this if you have watched the rates and return video, which is part of the foundation. My annualized return is equal to 1 plus the holding period return. This is what is the period? This is a 6-month return. Holding period return raised to the power m minus 1, where m is called as periodicity. How many periods are there in a year? How many 6 months are there in a year for us? So we are raising it to the power 2. 1 plus the return you get from IRR, then add it to that 1 and raise it to the power m, which is 2 minus 1. That will give you the annualized IRR. Okay. So do 2 steps. First, calculate your regular 6-month IRR, then annualize it. There's no discount rate. We are calculating IRR. No need for discount. We're not doing NPV, just IRR. I go to your cash flow function and clear it. Clear worksheet. CF0, we said is 30 negative. Enter, down arrow. C01 is how much? 0. Okay. 6 month, we are getting cash flow of, see, this one is minus 30, 0. At time period 1, I'm getting 20, 15, 30. So C01 is 0. Don't forget that. Then come down to C02, which is 20, enter, down arrow. C03 is 15, enter, down arrow. C04 is 30, enter. Compute my IRR. 28.766. Okay. Now I'm going to divide this by 100 and add it to 1. Y power x 2 minus 1 multiplied by 100. My annualized IRR is 65.8. Okay, now conceptual question. Let's say there are 3 projects, A, B, and C. NPV is 450 mil for the first project, 300 for the second, 150 for the third project. IRR 18%, 22, 18%. Okay. Would you choose which of this? Project A alone, B, B, and C? Okay. Now, the capital outlay for this is 500 mil. For this one is 320, and this one is okay. So we have 500 million in total capital. Would you do A alone, or would you do B and C, or would you do B alone? So we have a maximum of 500 million that we can spend, and we have to look at the capital outlay. So if I do project A, I can't do any other project. If I do project B, I'm left with 180, so I can also do project C. Okay, I have money to do it. And so in that case, I would do B and C or A, because I will not just do B, because I have these projects are NPV positive. What is the decision criteria? We said if NPV is positive, we should invest. If we have money, we should invest. Yes, we have money. So which means we are either going to choose between B and C or A. This one doesn't make sense. Why? Because this is a NPV positive project, project C, and we have extra cash remaining after spending 320 million. So we would invest in project C also. Okay. Now, whether to go with A or B and C, that is the question. So A is 450 million in NPV. B and C is also 450. But you can see the IRR is greater for project B compared to. So IRR is if you have equal outcomes, IRR is going to give you the decision which one to invest in. You can see that project B is giving a better IRR, which means the investment required is lower. We can see that it's not a lot. It's 495 million compared to 500 million, but still it is, we save 5 million for the same outcome. So we would go with project B and C. Okay, that's the second metric that we had to see, IRR, internal rate of return. So the third metric we want to see is our ROIC, return on invested capital, ROIC. What is this called? ROA, return on assets. So this one is one of those words that tells you the formula also. ROA or ROE, return on assets. So the numerator is your return. What is the metric we use for return? Net income, right? Net profit or net income. That is the return you get. Okay. Net income. Okay. And your denominator is, well, assets. Usually we use average assets for the period, but you can say assets, total assets, average total assets. And ROE is return on equity, or this is the shareholder return, one of the highest, uh, most popular metrics for equity holders, right? So this is net income by average return on equity average. Right. So, but now we are talking about a company. A company is not only equity, it is also made up of debt, right? So, debt in your balance sheet on the right hand side, we have liabilities and equity. And on the left hand side, let's say we have assets, and your equity is made up of sometimes preferred, but common equity, your usual shares, and you might have preferred equity also. Together is your equity investment. On the liability side, you have debt, long-term debt and short-term debt. But you might also have other liabilities. What are other liabilities that are not debt? Example of other liability. What is like a current liability? Accounts payable. Yeah. So accounts payable, wages payable, taxes payable. All these are non-debt liabilities. That is, you don't have to pay interest on that. These are liabilities, but you don't pay. This is not an investor, that they gave money for us. It is a regular operational liabilities. Okay. So for us, we are looking at return on invested capital. So which means, what are those things? This one and these two. Okay. So that is the idea here. The denominator is, when we look at ROIC, the denominator is going to be invested capital, average invested capital, which is primarily your debt, all types of debt, short term, long term, and equity. Okay, so that's your denominator. Your numerator is going to be what? Is it going to be net income? Is net income the right number to use now? He said like return means net income in ROE and all that. That's a good starting point, right? Why can I not use net income? Because this one has equity and debt. Net income, I already paid interest. Okay, so then it's like not really the right number to use, because the return to the invested capital also includes the interest part. Income statement. So from your revenue, you subtract your cost of goods sold, we get gross profit is GP. From your GP, you subtract your operating expenses, SG&A, R&D, and all that, you get EBITDA, earnings before interest, taxes, depreciation, and amortization. Yes, you just a subtraction, and then you get this EBITDA. We will see this in your financial statement analysis. Then you subtract depreciation, amortization, you get EBIT. Yeah, this is a proxy for operating income, not necessarily operating income, but might have some discontinued ops also. But this is your operating income. From this, we subtract interest, then we get pre-tax income or EBT. Then from that, you subtract tax to get to net income. What we are going to do is we are going to start here for the numerator, because this is for both debt holders and equity holders. Because from this only we subtract interest, which is a return to the bond holders, the debt holders. But I still need to pay taxes. Okay. Operating income adjusted for taxes. Net operating profit adjusted for taxes. This is also called as NOPAT. What is it called? Net operating profit after taxes. NOPAT. Before we look at some questions, I'll talk about one more step. From this ROIC equation, what we are going to do is we are going to decompose it into a two-step formula. We said ROIC is equal to NOPAT divided by invested capital, average invested capital. I'm writing it as invested, but it's usually average. Now, this is an aggregate measure of profitability or return for the business. So, I want to understand how this is happening. This is compared to NPV and IRR. This is not an individual project measure. It's an aggregate measure for the entire business or company. When I create an income statement, it is not for a specific project. It's for the overall company we are talking about. When I did NPV IRR, it's for specific projects. Right? This is an aggregate measure. Okay. All right. Now, what I'm going to do is I'm going to multiply the numerator with sales or revenue and then denominator also like that. So NOPAT, and we will have sales on both the numerator and denominator. So we have something like this. What is NOPAT by sales? That's your NOPAT. Anything you divide by sales or revenue, that is going to become a any profit you divide by revenue is going to become that margin, right? So gross profit divided by revenue is your GP margin. EBIT divided by revenue is your operating profit margin or EBIT margin. Margin is a percentage of revenue margin. Yes. So this is your NOPAT margin. Like what does that tells you? It is about the profitability for each unit of sale, right? How is the profitability? And this one, sales by capital, what is that? Turnover. Turnover means how many times I'm rotating my capital, right? So this is a capital turnover. So we can say the return on invested capital is dependent on the margin and the times you can rotate the capital to generate sales, capital turnover. So these are two drivers. So you can have a business with a high margin or high capital turnover, usually very tough to make both of them high. Because if I am in, say, in the manufacturing of cars, it's going to take some time to manufacture it, buy the raw materials, manufacture it, send it to distributors, sell it, and all that. It's going to take time. Whereas I can be a trader, I can become a car dealer. I buy the car, sell it to the customer. I can rotate the capital very quickly, but the margin I make will be lower because I'm only capturing some portion of the value. Whereas if I capture the entire value, then I will have a higher margin, but then I will not be able to rotate it as fast. I will have to block my capital for longer periods. So we have to see that the reason why we are doing this decomposition is to see what is driving the ROIC for that. Okay. Now let's look at one question. So this is a practice question. I'm saying the EBITDA is earnings before interest, taxes, depreciation, amortization is 200 million. Property, plant, and equipment of the firm is 1 billion. Depreciation percentage is 10% of the PP&E. Debt of this company is 400 mil. Equity is 600 mil. Tax rate is 20%. Okay. Compute the ROIC. After tax operating profit divided by invested capital. That is your EBIT multiplied by 1 minus tax rate divided by invested capital. Invested capital is 1 billion 400 plus 600. That's your total capital, 1,000 million or 1 billion. We know that. My denominator is that 1,000 million. What is my numerator? We said EBIT into 1 minus tax rate. That is your operating profit multiplied by 1 minus tax rate. They gave EBITDA, which is one step above EBIT. From EBITDA, what do we have to subtract? Depreciation. They gave depreciation rate. They gave the property, plant, and equipment. So what is your depreciation expense? 100 million. 1 billion into 1 billion means 1,000 million multiplied by 10% is 100 million. So from my EBITDA, I subtract this 100 million of depreciation to get EBIT of 100 mil. Okay. So 100 million is my EBIT, then multiplied by 1 minus tax rate. Tax rate I gave as 20%. So this becomes 80 divided by 1,000. So my ROIC is 8%. Right. Shall we move on to the second part of this question? If capital turnover ratio is 1.5, this is turnover ratio. What is the revenue of the firm? How are we going to calculate this? We're going to use the decomposed formula to calculate the revenue. You now know the ROIC already. Calculate the revenue or sales. Okay, so we know this. We can write ROIC as notepad margin, which is your notepad, divided by revenue, multiplied by your revenue by capital, invested capital, which is your capital turnover ratio. So I'm going to write it as like that because they gave directly this value, capital turnover. Okay, so this one is 1.5, they said, and we know the ROIC is 8%. And NOPAT we calculated as 80, I think. We have to solve for revenue. So just cross multiply that. So my revenue is equal to 80 by 0.08. So my revenue is, as you guys said, 1,500 million or 1.5. Now I want to move on to capital allocation principles. Let's say you are a contractor and you want to build roads. Okay, so you go to the government and you create a road or bridge or something, and you give a proposal. Okay, and say this bridge costs 100 million to build. It's not a really number question. I'm just giving you some numbers for idea. But then to get this project, you develop a prototype. You build a prototype, you go to the roads and highways ministry and you present your idea. So to do this prototype, you will have some cost. Okay, let's say this is 500,000 or 500,000. This is the prototype cost. Okay. Now, then you get the project. Okay. Then you get the project. The project, they say you can do some monetization over 10 years. That is, you can have a toll over the bridge for the next 10 years. Okay. So you do some math and then you come up with some cash flows 10, 20, 25, like this for 10 years. Okay. The question I want to ask is, this is the cost of the bridge. Do I need to add this 500,000 cost also when I calculate my MPV? Should we include the prototype or any prior costs to the cost of construction of the bridge to make a decision? I'm not talking about the NPV as to calculate it. I'm asking a decision whether to go ahead and accept the project or not. Go no go decision. For that, should we include this prototype cost? Yes or no? A is yes, include the 500K prototype cost. B, no. Okay. So in corporate finance, this is a cost we call as sunk cost. Yeah. Whatever decision we make, that cost is incurred. Whatever decision we make now, that has already happened. Okay. This we cannot recoup either way. Okay. The question to invest now or not is based on the future cost, future cash flows, present and future cash flows. It's not about the past cash flows. Someone joined sociology in their bachelor's, that is done. We have to see what to study in the future. You understand this? So whatever we have done in the past, we can't keep going back and say that cost I incurred, so I need to do this project. No, we don't have to do that. So we have to think about the current capital outlay and the future cash flows and discount it to today. That's it. We might have done some work in the past. We don't have to worry about it. Sunk cost, we should not include. So first principle, sunk costs don't include for computing the NPV. The second point, I already mentioned this in that question. For taxes, we are going to use after-tax cash flows. And we cannot use any accounting measure like profit, net income, revenue, nothing like that. It's always cash flows. It kind of goes without saying, but I want to make it explicit. No accounting measure. It has to be a cash flow measure. Okay. The fourth point is that timing of cash flows is very important. 100 million I get next year is not the same as 100 million I get after 20 years. So we have to be very specific about when we expect the cash flows, timing of cash flows, accounting measure. So before I say the fifth point, maybe you can help me here. So I think this is the example I often quote. We'll go back to Asia, okay? So you go back to Royal Enfield. So let's say Royal Enfield is going to launch a EV bike. What do you think about that idea? Okay, now let's say like general population like EVs, okay? So they're launching EV bikes. Okay, now they have a projection. They're expecting to sell 10,000 units in the first year. Okay, should I include that 10,000 into whatever the cash flow I get as incremental cash flows for the project? If let's say that each bike I'm selling for maybe 200,000, okay, make it a little bit realistic. So 200,000 rupees multiplied by 10,000, whatever is the cash flow, can I have that as the cash flow for next year? They're asking you to evaluate the project, whether to launch a EV or not. So there is someone is doing a market study and saying, okay, if you launch a EV product, people will buy it and this is the expected number of sales. Okay, 10,000 first year, 15,000 second year, and so on. You will project the vehicle numbers quantity multiplied by cash flow. You will get the actual cash flow. Can I just use that number and whatever is the capital outlay? Initially, I need to build a EV plant. So maybe for that, I need like 100 crores. Shall I do that? Is that fine? Normal? Anything else I have to consider? Seems good to me, right? Seems good. What else can be an issue? There is something called as cannibalization. Okay. If I sell 10,000 EV vehicles, EV bikes, maybe people who are buying the regular Thunderbird or like, Himalayan might not buy it and might opt for the EV. So you need to adjust for the reduction of your existing product that you are selling. For this, we are talking about basically incremental cash flows. And this can be positive sometimes also, but usually you have to think about cannibalization, that is negative effect. Sometimes you can also have synergies because I do this project, my existing business can benefit. If I'm already having a EV company, EV bike company, if I also if I have a battery plant, it might actually help me with the current business. Okay. It might have synergies, cost synergies, etc. It can also be positive. So you need to think about incremental cash flows as a general rule. Fifth point. Okay. Sixth one. Okay. What about interest? Okay. Let's say I finance this project with bank loan or some debt. Okay. That will be interest cost. Do I subtract the interest cost or not from the cash flows? So this let's go back to this 100 crores investment for this EV plant. I get a loan and I do it. So the loan has some cost, interest cost. So should we subtract that interest cost every year, whatever interest I pay from the sales of the bike? Just go back to we are talking about NPV now. Okay. We are just talking about NPV. See, we are having these cash flows and then I am discounting with some rate. What did we say is that rate? That is called as or it's more broadly, the cost of capital that we are using for discounting. The cost of capital includes the cost of equity and cost of debt already. That is why we are discounting it. Okay. Whatever is the company's cost of capital is factored into that discount rate. We don't have to again see what if it was internally generated funds? Then is there should we not have deduct anything? It doesn't matter. We are discounting whatever. The point is we are agnostic to the source of fund, whether it is equity, debt, or internally generated funds. We are discounting with the company's target structure, capital structure, cost of capital. Okay. So we can't deduct interest or preferred dividends or equity dividends. Nothing is required. No need to deduct. Okay. Don't forget. We can say we are indifferent to the source of financing. The capital allocation decision is indifferent or agnostic. After this, there are three more LOS on real option, crossover rate, and pitfall. But before that, I'm going to talk about one behavioral biases in capital allocation. This is almost there in almost every topic. They talk about the behavioral finance aspect. This is like psychology plus finance kind of a thing. What are the behavioral biases in capital allocation? There are four. The first one is inertia. So this is if you have ever done budgeting for a company oftentimes what do? You start with prior year budget or prior year actuals. If let's say I'm doing department budgets, so usually you do a budget for a company, you would have the operating budget and then you have the discretionary budget. This one will come under what? Operating budget is like the business as usual. This will come under discretionary capital expenditure, extra. It's not something you need for running the company. This is to grow in the future. That's what we said, right? This is about growth. Right. Okay. So let's say I'm doing this capex budget, production, R&D, marketing, and if I have, I mean, you don't have to write this down. I'm just trying to make a point. 2025, if I have 30, 25 mil, 10, this is what I gave. Now, this is the time when people start the budgeting process for next year. And then they will say, okay, this is 32. Now last year I had 65 million as discretionary budget. This year I have 70. Okay, let's give two more, and one more, right? You understand this? They just increase a little bit. They start from the prior starting point and then they just change a little bit. This is called as inertia, right? When we allocate, instead of using from like proper analysis techniques, doing based on what is the NPV IRR, people often allocate based on inertia. Second one is basing investment decision on accounting measures. Oftentimes people use net profit, EPS, what is the incremental earnings per share. These cannot be used. We have to use cash flow. We already said this one. The third one is pet project bias. So this is sometimes certain projects are preferred by senior management and they do it just like Answer of Matrix. This is another framework, consulting framework where in BCG, they look at a company's various lines of business and they will, in the y-axis, let's say I want to look at their market share, and on the x-axis, the growth, market growth. So this one is the market industry as a whole, right? Market growth rate. And this one is their market share. If the market share is very high and very low is on the bottom quadrant, and market growth, let's say this is low and this is high. Okay. If I have a high market share and then that market is also growing, let's say you are in an AI space or electric vehicles, things like that, market is growing very fast and you also have a market share. Should you invest in that area? That's not high risk. I don't think so, right? Like you are already very strong in that area. You have a high market share. That means you are pretty good in that. And the market is also growing very fast, right? So that's a good thing to do, right? You should invest in that kind of an area. This is in the BCG calls it as a star area. Okay. So this they call as a star. You should invest in this. Okay. If the market share is high, but the market growth is low, okay, this is kind of a mature industry. Mature, that means this is not growing. But this might be your IC engines, internal combustion engines, but it's not growing, right? But you have a high market share. You might be the Toyota of the world. So what do? Do you invest in this? Yeah. So this one, you don't have to increase the capacity. You don't have to increase, but this is what we call as a cash cow. We need to optimize it, work on efficiency improvement, cost reductions, and extract the cash from the business because you're still having a very good business but it is not growing. So we don't have to expand capacity. There's no extra demand coming in. This is a cash cow. Now, what about this one? Market growth rate is high, but we are not good at it. That is, our share is low. Then this is a question mark, they say. Okay, whether we can, like maybe we missed the boat on the AI, like Intel did, and now they're figuring out should they invest in AI or not, AI chips, right? So that's a question mark. And what about this? Low market growth, low market share. Should we invest in this? No. They call this as the dog or pet. This is a pet project of the CEO or someone. Okay. Should we invest in this? No. Don't do pet projects just because someone thinks it's a good thing. There was something called as a metaverse in Meta, Facebook. We have a lot of investment done by Facebook, right? Why? Because Mr. Zuckerberg liked it, right? But if then AI came and no one now talks about metaverse, right? Okay. That's a third one, third bias, pet project bias. And the fourth one is kind of like failure to consider other alternative. This is a very catch-all kind of a bias. Failure to consider investment alternatives or alternative scenarios. Like, okay, maybe we can do EV, but then maybe there's also other things we are not considering. So should we consider that? Did we bring all the projects in for our evaluation or move on to crossover rate? This is not actually LOS. I saw a question, but to do that calculation, we need to understand crossover. The question was like this. Okay, so they have given two projects here. This yellow one might not be clear. So the capital outlay is 100 on both the projects cash flow for the first investment outlay. Then you have some cash flow 36, 36, 36 for the first project. And the second project, there's no cash flow for the first 3 years. And then you have 175. Okay. They have also given the NPV for both the projects. It's already given. This is a question from the curriculum directly. And they also gave you the IRR. Now, the question asks, what is the discount rate, your R, or in your calculator, the I, that will make both the projects the same in terms of NPV? We want the NPV to be same. What is that discount rate that will make the NPV of both the projects to be the same? That is the question they are asking. Okay. To calculate that, basically there is one discount rate. So the NPV of the project here is higher in the second one compared to the first one. But there is one rate at which both the projects will have the same NPV. They are asked to calculate that. That is called as the crossover rate. The reason why they ask is this. So if you present this data to your CEO, the CEO might ask, okay, what was the discount rate you used? What if you change it? Will it change the NPV? Okay. So there will be a certain discount rate where both the projects will mean the same because of the timing differences. Okay. So we are going to calculate that. How to calculate this one? It's very simple. Crossover rate is just a two-step calculation. First thing you have to do is to calculate, you will calculate the difference of the cash flows, the delta, the difference of the cash flows, then calculate the IRR of the first step, the difference of the cash flows. And that is your crossover rate. We will do this together. Delta means the difference. The question is like which delta, how to subtract 1 from 2, 2 for more. Doesn't matter. Either way, it will be the same answer. You can subtract one cash flow from the other. So let's do step 1. We subtract and we have these timelines 0, 1, 2, 3, 4. For the first period, what is the, for 0, minus 100, minus of minus 100, it will become 0. Then let's say I want to subtract 1 from 2. So 0 minus 36. Oh, you do like this. You subtract 2 from 1. 36 minus 0. 36, 36, 36. The last one is 36 minus 175. How much is that? 139. So this is the negative. So now this is the first step. Then calculate the IRR of this delta. This is the delta of the cash flow. The difference between 1 minus 2 I did. You can also do 2 minus 1. So I'm going to do this. You can do this along with me just to save time. Punch in your values in your cash flow sheet. CF0 is 0. CF1 is 36. Enter down. Then again a 36. Again a 36. Then minus 139. Go to your IRR, compute 13.159%. At a discount rate of 13. The NPV of both the projects will be the same, and this is called as the crossover rate. Calculate the revised NPV of the first project with this IRR that I have flashing on my calculator, 13.15940, 6.73 for both the projects. I will just do for project 2, see if I'm getting 6.73. Cash flow second clear worksheet. CF0 is 100 negative, enter down arrow, 0, enter down arrow. Then my C04 is 175, enter, and then go to my NPV. My I is going to be that 13 point, I didn't save it, and 15, something like 6.73. Both are getting the same. And so at that discount rate, we get the same NPV. Both the projects are equal in value. That is called as your crossover rate. Real options is when we talk about real options, so you do some investing in a capital project, then later on you get some additional options available to you, opens up additional options. As an example, let's say you are a manufacturer of something, you're manufacturing, say, tires. So you are Goodyear or you are Michelin, manufacture tires. Now you might sell your tires through a distributor, retail network, etc. Maybe not your own distribution, but someone's through some other distribution. Maybe it is like the car dealers or some kind of a person who sells tires. You will sell it, but then you can then make a decision to open up your own distribution, which will cost money. So that is a capital investment decision. Then you have to make a choice whether you have to do that or not. So you're going to say, okay, you know what? I'm going to open up my own stores. I want to open up my own distribution centers. Now, when you do this, you obviously need some capital investment. Let's say this costs $1 billion. This is your initial capital outlay. But what is the benefit you get when you open up your own distribution center? You will more margin. You will cut out the middleman. Like you don't have to pay the dealer, distributor, wholesaler, all of this. You do it directly, right? So you will have some additional incremental cash flows, right? Positive cash flows over the course of the remaining years, like until those distribution centers are can be used. Okay. Now that's the benefit of this. Okay. This is one thing. This is how you will value this investment, and you will calculate your NPV, IRR, all of this. But let's say after some time, say 5 years, 10 years down the road, once your distribution centers are spread out throughout the country, you have a good network, can you use it for other purposes? Say maybe you can sell something else, right? So you might be selling like a engine oil or the lubricants along with the tires that you're manufacturing. So you can become like a shop, right? Service center. Also, you can add additional businesses. You can think of various ways you can utilize this distribution center. So these are options that were not available to you before doing this investment. Now that you have done this investment, now let's say you have 1,000 stores selling tires. Now, can you also add a bay to do a quick wheel change, tire change, oil change, lube change, all of that? Yes. Now you have an additional source of revenue that you can consider. Obviously, it will require some more investment, right? Because you need to build a way for the cars to come in and do that work. But now you have an option. You can use these distribution centers maybe as a service center, or you can sell third-party products that are not yours, right? So why, maybe it's not tires, but you are selling something else, right? From maybe even you can sell your competitor tires also. That's an option that you have. You don't have to do it, but you can have other options. These are called as real options. Okay. So there are a few ways in which real options can be categorized. So we will look at the types of real options. There are 4 ways in which you can categorize it. The first one is timing option. A timing option is you can delay or postpone or prepone the option. Like maybe I want to use it as a service place also. When do I start that? That I have a control. I have a control of when to do that. So that is an option by itself. The second one is a sizing option. So I opened up 500 distribution centers. Now, can I increase it to 1,000? Another 500? That's a growth option that you have. And you also have the ability to, if it doesn't work, to abandon it. That is also a real option. There's a value for that. Like, okay, I try out 100 stores. It's not working out. We can shut it down and continue with our existing distribution network. Okay, so this is a sizing option. A third one, then a third thing is the flexibility option. What is flexibility option? So let's say I'm investing in a project. Right now, my factory uses coal only as the source of power. Now I add, a way to switch to a grid, the electricity grid, or I am able to take on diesel as a fuel source, or solar, wind, etc. So when I do this, I can switch from one source of energy to another source. It gives me flexibility. Okay. It doesn't mean I have to switch, but I have the option now. So this has some value because whenever the price of diesel comes down, or when the price of coal comes down, and the price of the electricity in the grid is cheaper, I can switch to the lowest source of fuel, right? So that's going to give me some value. So that's a flexibility. The last one is a fundamental option. The fundamental option is in terms of the actual asset itself, the price can change. So if I am running a coal mining operation, the price of coal, if it changes, only then I might mine it. Okay. If the price increases, then I might mine it. If the price decreases, I might stop the operation. So this is based on the price here. In this case, the price of coal, which is a fundamental input. It's an external input that drives the value of this option. So now let's move on to a simple problem on real options. The estimated NPV is minus zero point 0.4 million. And so this one, just by itself, do we invest in this project with this NPV? No. But let's say I do some incremental investment, okay, some kind of extra work I do. And for that, it is going to cost me zero point 0.3 million. Maybe this is the flexibility thing I said. I can add some energy source flexibility here with another 300,000. And the value of this energy source flexibility, say, is 1.2 million, the option value, real option value. What is the value of the option? What is the value of the project, including the option? Revised value of the project. Now that I consider the option also, I'll just tell about option. See, if I told you that you can buy Apple at the price of $400 next year. Okay, right now the price of Apple is what, like 230 or something. Okay, but then I tell you that you can buy Apple at the price of $400 next year, you might think that that's kind of useless, right? You might think, okay, right now it's 230, it's not going to go to 400, right? But will you get it for zero, the option to buy it at 400? Will you get the right for paying nothing? Will someone give that to you? No, there is a price of every option, even though how far-fetched it might look. So when we do a valuation of an option, we are going to say in the future, because Apple has some volatility, we are expecting some future price changes. There is some value to that option. This is a call option where I can buy it at a specific price in the future, and that gives some benefit to me, the owner of the option. Same way, if I am doing a project and I am tire company opening stores in India, all over India, then later on, even if it is far-fetched that I might use it to open a service center, that is still some value to it, right? So we are trying to find that value and add it to the discounted cash flows, the NPV that we already estimated, to get a revised value of the project, including the real options, the alternative pathways it might open up. See, because right now I am not considering any other alternative pathways. When I am doing a NPV analysis, I'm just saying, okay, I want to open up this distribution center. What is the benefit, the reduction in cost? This is the incremental cash flows. I'm discounting it, calculating NPV. But what if someone wants to do something in the future and they can use that space that I opened up? So there is a value to that, right? So we are calculating that value and adding it to the NPV to get the revised NPV. And maybe there is some extra cost associated with unlocking that option. And we need to consider that cost, but we are also considering the benefit of that option. Okay, so let's calculate the revised value of this project, including the real option. So the NPV without the option is minus 0.4. Then you are investing incrementally another 300,000 or 0.3 million. And when you do that, the value of that option is 1.2 million, right? So just some addition and subtraction. That's what we have to do. You don't have to do anything difficult here. So you're starting with negative value. So when I start with this, my value of the NPV is minus 0.4. You guys said we will not invest because it is a negative NPV. But then what we are saying is we'll further do some investment. So this is going to be another 0.3. So now I am down by 0.7. Okay, because I'm doing another investment. But then now this is the value, but then I have an option of switching energy source that has a value of 1.2 million. So together, what happens? I now have a value of 0.5 million. So that is how you do it. Okay. So you're going to be doing NPV of minus zero point 0.4, initial capital incremental outlay of 0.3. The real option value is 1.2. So the new project the value including the option would be 500,000, 0.5 million. Write it down. Each of these. Incremental capital outlay is this, and then you have the real option value. So the new project project NPV, including option, would be point. Let me try explaining this slightly differently. So you do NPV. NPV is what? How do you calculate it? Summation of I is equal to 1 to n cash flow divided by 1 plus R to the power T. Right? So every period cash flow, you discount it, and then from that, you subtract the capital outlay. You're just going to use the calculator anyway. This is just the formula for NPV. You do this formula, you get an NPV, you get a negative value here. In our case, it was 0.4 million. That's fine. But what we are saying is, okay, now this, because I did this project, I'm having a 0.4 million negative NPV. So I can't invest in it. But then if someone in your team tells you, okay, you know what, to this, we will add another investment, new investment, incremental capital investment. And this one is going to be minus 0.3 million. So now what happens? This is also in today's time. So you just add to the minus 0.4. So your new NPV will be minus 0.7, right? So the revised value of this project is not really a formula. So this is your NPV. To that, you add the real option value. That's it. What is the option value? It was directly given in the question. Now, this option was not there before this 0.3 million. Now that we have done this unlocking of this option happens. The value of this option is 1.2 million. So 1.2 plus minus 0.7. So your new value is 0.5. We just have to add the real option value to the NPV and any other capital outlays we have for unlocking that real option. Next one is not necessarily directly related to real option. They're saying we are investing 600 million in distribution facilities today. Present value of the future after tax cash flow is estimated to be 850 million. Outstanding shares right now is 200 million. Share price is $32. What should be the share price of the company if this project is undertaken? Okay, what will be the new share price? So the idea is when you do a positive NPV project, it increases the market capitalization. Yesterday we said it is a wealth measure. NPV is a wealth measure. It increases the market capitalization. So it should increase the share price if it is a positive NPV project. So what is the NPV? NPV, we said, is the present value of future cash flows, sum of that, all the future cash flows. And they have given this value as 850. Okay. Then we also have to subtract capital outlay, right? So that's the definition of NPV. That's what they have given. Capital outlay is how much? 600. Investing 600 means that is the capital outlay required. So my NPV is 250. Okay. So this is the increase in wealth. Per share, what is the increase? This is the change in wealth or market cap in our case is 250. Change per share would be 250 divided by number of outstanding shares. And that was given directly. So we can substitute that to be 200. So that is what? 1.25, right? 250 by 200. So this is the increase, okay? Not the price itself. So we'll have to add this. We will have to add this to the current market price. So new share price, current market price plus the change in the share price. This will be 33.25. This is 32 plus 1.25. So the new price is 33. This is a wrap on this learning module.